Hey there. In this video, I want to continue with our Options 101 series and discuss delta neutral spreads. We've discussed bullish trades so far. We've discussed naked puts. We've discussed short put spreads. We've discussed bearish trades, short calls, and short call spreads. So I want to go into so-called delta neutral spreads today. And we'll discuss some of the terminology because some of these spreads, for whatever reason, have very unusual names. So a lot of times people have issues with the terminology rather than the details or the mechanics of how these trades work. So let's jump over to a presentation and we'll intersperse the slides with setting up some of these trades over on Tasty Trade. So it's a Sunday evening. It happens to be August 24th, so we won't be able to actually route or implement any of these trades. But I think it'll be a good idea to see how they're built, just to give a visual. Seeing it visually and seeing some of the numbers will help with understanding. So what exactly is a delta neutral trade? Well, we've already discussed bullish and bearish trades, and we've discussed the meaning of delta. So delta is the theoretical number of shares that you're long or short. So if a position has 30 delta, you're long, theoretically at least, 30 shares of that stock. If you're short 30 delta, so you have a negative 30 delta, it's a bearish position. Okay, so a delta neutral position is simply one where the total deltas of the spread come close to zero, so they're a small number. So why would you want to do such a trade? If you're a premium seller like I am, you're basically betting that the stock is not going to move a hell of a lot. So you're betting on a range. If you are buying premium, if you're buying these spreads, what you're essentially betting on is a huge move outside of the expected range. And generally speaking, you would like that to happen in a short amount of time, because these trades work in the favor of the premium seller. You're again betting that you're range bound, and then the spread's value is going to drop towards zero. So there are several common variations of delta neutral trades. Some of them are called straddles, strangles, butterflies or iron butterflies, and iron condors. Why are they called that? I have no idea, to be honest. I generally do not do straddles or butterflies. And as I've probably noted before, a strangle is my go-to trade, and sometimes I will do iron condors. So let's just go through these one by one and just briefly talk about what they are, and then we'll move on to more detailed descriptions of the risk and then setting up these positions in Tasty. So a straddle is simply selling an at the money, or buying in this case. Selling in my case, buying in some cases, an at the money call or put. Whereas the strangle is selling an out of the money call or put. And then basically the butterfly or iron condors are defined risk variations of those two trades. So the classic butterfly is selling an at-the-money call spread and an at-the-money put spread. So it's very similar in concept to the straddle, but it's a defined risk trade. Likewise, the iron condor is selling an out-of-the-money call spread and an out-of-the-money put spread. So let's start with the straddle. So I made up a hypothetical situation, and when we sell, it's a $100 stock assumed. It's a theoretical model here, and I assume that the credit received for the straddle is $8. So if we sell the at-the-money call, at-the-money put, we collect $8. And this plot here is basically our risk profile. So if the stock at expiration as the stock drops, we're going to end up losing money at expiration dollar for dollar with the decreasing stock price. Likewise, if the stock goes up, we'll also start to lose money dollar for dollar as the stock moves higher. So basically, you are hoping for a pin at $100 or not much movement about that $100 point. Now, why would you do that? Well, you collect a lot of money up front, and your break-evens gives you quite a bit of range to work with and still collect a profit. So here it looks like our break-evens are going to be like it's going to be exactly $92 on the downside and $108 on the upside. So we do have that $16 of wiggle room on this trade. But I do not do these trades with any sort of regularity. I find that they're roughly a 50-50% chance of making money, and I prefer a higher probability of profit. So moving on to the strangle, and this is my go-to trade. It's the sale of the out of the money call input. This again, just like the straddle, is undefined risk. So you have a huge, there is a capacity for a big loss, but your break evens are wider. So in this example, again, I use a $100 stock, and I assume we were collecting $6 in premium by selling the 90 put and the 110 call. So as you can see, at expiration, our profit, our total profit is capped at $6, but we have a fairly wide range in which we would make that full credit. So anything above 90 or below 110, we're good to go. But once we start going below 90, again, we start losing money dollar for dollar, and our break even point here is going to be our strike price minus that credit received. So we're still good all the way out here to, what is this, $84. And it's same thing on the upside here. We lose money dollar for dollar, but we're good to a fairly wide range. So we effectively have a $32 window in the stock price where we will still end up profitable. And in reality, we're not looking to collect that entire $6. So we're not looking to hold these trades to expiration. We're looking to collect 50% of that. So in this example, $3. And in the straddle example, I'd be even more aggressive managing winners and looking to take it at like 25% profit. So if in this case I collected $8, I'm looking to take only $2 out of this trade before I close it. So let's jump over to Tasty and build these in the platform. And I'm going to use Netflix as my example. So here we are in Netflix. As you can see, it's a very expensive stock. It's trading just above $1,200 per share. I'm using this as an example because I do not have any positions in here. In reality, I don't think I'd be trading this at the moment because you can see here the volatility rank is pretty low. So it's a single digit volatility. So I wouldn't be interested in short premium trades in this underlying. But I'm just going to use it as an example. So let's assume, let's see here, the 1205 strike, we'll call that the at the money strike. So if I sell an at the money call and an at the money put, I'm bringing in a very large credit here. $126 and change. Remember, there's a multiple of 100 there. So for that single spread, I'm bringing in well over $12,000 of credit. But as you can see here, our probability of profit is only at 57% according to the platform. And here's our probability of making 50% of that total credit. And it's actually lower. So it's not even 50%. So this is not a trade I particularly would like to enter into. So let's go on to the strangles. So as we said, the strangle is an out of the money call input. So just take this and move it down to, where do I want to move it down to? Let's go out to roughly where this dash line is here. So that would be the 16, 17 delta put. And let's go to a similar delta call so that we're delta neutral, so that those two sum up to 0. So roughly, let's go right here. That's the 17 delta. So the platform calculates the delta of this position. So we're only short in this example here, -1 share. So we're short basically a single share of the stock. You could see our credit received is significantly less. So we're receiving like $100 less credit. Not that $27 is anything to sneeze at. It's still, $2,700 per spread. But now our probability of profit is way up here. So we're looking at 76% here, and the probability of making 50% is closer to 89%. So these are the types of trades that I generally like. But one problem is some people don't like to trade naked positions, or don't have permission to trade naked positions, or in Netflix, because it's such an expensive stock, your buying power reduction would be huge. So this account actually has portfolio margin, and to put on this strangle, I would still need to put up over $18,000 just to do a one lot. So, maybe you're not comfortable with that. So I probably would not be comfortable with that. So you could use defined risk variations of those trades, say the butterfly or the iron condor. So let's switch back to the presentation and we'll discuss those trades. So here we are with our butterfly. It's very similar. You notice the risk graph here is kind of similar to the straddle, except our losses are capped because it's defined risk. This is the sale of an at-the-money call and put spread. You could also think of it as the sale of a straddle and buying a wider strangle to define your risk. But you collect a lot less premium, and your POP, your probability of profit, is lower than even the straddle. So let's switch back over to Tasty and let's discuss the butterfly. So let's see here. Let me just clear this out here. We'll go back to the at the money and we'll sell this straddle, and we will buy a strangle to turn this into a put spread and this into a call spread. So let's go, you could go various widths here. So it's $1,205. Let's go $30 wide. So that would be what, $11.85 would be $30 lower. I'm going to buy that. And $30 higher would be $12.40. So I'm going to buy that. So I have 4 legs to this spread here. And let's see here. So our probability, we're profitable basically. Oh, sorry, I misentered it here. So I'm selling the 1205 straddle. I'm buying one of the 1185 puts and buying one of the 1225 calls. So as you can see, our break-even range is pretty narrow for a stock like Netflix that moves, $100 a day sometimes. So the probability of profit on this trade is only 9%. So this is not a trade I would do here. The probability of making 50% of max profit is only 6%. It's not even the same as the overall probability of profit, which is weird. It's a Monte Carlo simulation, so this number, can vary. You can always widen this, so you'd be taking more risk. Here we're collecting almost the full width of the spread. Remember, this is 30. Oops, when I readjusted it, I only adjusted it to 20. I wanted to be $30 wide. So 12, that's $11.85, and this should be $30 higher is 35. That should be here. Is that right? Oh, let me see if I could do the math. Yes, that's correct. So this is a $30 wide spread, and we're collecting almost $23 here. So the probability of profit here, this looks more realistic here. Probability of profit is 57%, so it's basically a little better than a 50-50 bet here. And yeah, but that makes sense because we're collecting almost the full width, 2/3 the width of this, more than 2/3 the width of this spread here. And you can make this more like a straddle by taking these strikes farther out, these long strikes that define your risk. So you are taking more, significantly more risk by doing that, but your probability of profit is going to go, should go up accordingly. So lastly, let's talk about the iron condor. Well, the iron condor is almost like the defined risk variation of the strangle. And you can see that here from this plot. It looks almost like a strangle risk graph, except our maximum losses are capped. So it's the simultaneous sale of a out-of-the-money call spread and out-of-the-money put spread. So remember, butterfly is at the money, iron condor out of the money. It's going to have a lower premium. You're going to collect less money, and the probability of profit is going to be lower than a strangle, but you're getting defined risk. And traditionally, the way these things are done by a lot of people, myself included sometimes, is we want to collect 1/3 the width of either the call or the put spread. So if those spreads are $3 wide, I would want to collect at least $1. So in that case, we'd have $2 worth of risk. Our maximum loss is capped at $2, but it gives us a higher probability of profit. And just like moving the long strikes away on a butterfly becomes closer and closer to a straddle, the wider you go, the wider these calls and put spreads become, the closer to a strangle you get. So a lot of people will do this. Like in the case of Netflix, I might do it because it's such an expensive stock. I don't want to put up almost $20,000 per one lot. So I might do a wide iron condor, which will cap my losses and also reduce the amount of money that I need to put up to make a trade. So let's go back to Tasty and set up an iron condor. So we need to sell a call and put spread. So I don't know what we want to sell. Let's go $20 wide. So the most the spread can be worth would be $20 or $2,000 per one lot. So if I sell the 1050, I'd want to buy the 1030. That's my put spread here. Let's go to the call side. Let's sell the 1360 and buy the 1380. Again, $20 wide. Our deltas on this position are basically zero, so it's minus 0.25. We're collecting $5, so we're collecting about 20 quarter the width of the spread. So I want like more, so I'd go here and then I bring this down here. Is this still $20 wide because these strikes are funny? Yes, it is. And let's go to the put spread and we'll just bring this in 2060 or 1060, 1040. And that $6.57 is a little closer to 1/3 the width of the strike here, or 1/3 the width of these spreads here. So that's the number I would go for a standard iron condor. Our probability of profit is about 64%, and the probability of making 50% is about 70. What is that? 79%. So pretty good. The wider again you make this, the more credit you're going to receive, and the more it's going to come to resemble a strangle. So if I were doing this, I might make these fairly wide because my buying power here is only 8,000 something as opposed to 18,000. So I can make these even a little bit narrower to reduce that even a little more. So now my buying power, I only need to put up $6,000. We're collecting a lot more money. We're collecting 18, and our probability of profit is getting closer to 70%, and the probability of making 50% is almost 80%. So yeah. So this was basically a terminology video. We're just going over some basic spreads. Again, I don't do butterflies or straddles with any sort of regularity. I am a strangle and iron condor type of guy. So if you guys have any questions, please feel free to leave them in the comments. If you have themes or topics for other videos, again, please feel free to leave them in the comments. And if I end up making a trade in either a straddle or a strangle or iron condor tomorrow, I will put it in a pinned comment attached to this video. So great. Until next time, good trading and see ya.